Estimated Tesla order backlog stabilized. The estimated Tesla global electric car order backlog remains stable, above 100,000 units, although on the local level, the situation is quite dynamic. According to Troy Teslike, an invaluable source for Tesla stats and forecasts, the estimated order backlog as of February 28, 2023, was 106,000, so exactly the same as 2 weeks earlier, February 15, 2023. That's a clear indication that the price reductions, applied globally, allowed Tesla to find an equilibrium between supply and demand, after several months of rapidly decreasing order backlog in late 2022. The numbers are based on carefully tracked Tesla-related stats, production volume, average wait times for each model, as shown in the attached tweet. The number of 106,000 units corresponds to about 30 days of manufacturing capacity, no change here, according to the report. For reference, here are the numbers for previous periods, wait times. February 28, 2023. 106,030 days. February 15, 2023. 106,030 days. January 31, 2023. 87,026 days. January 15, 2023. 107,030 days. December 31, 2022. 74,023 days. December 8, 2022. 163,040 days. November 30, 2022. 190,044 days. October 31, 2022. 285,000. September 30, 2022. 299,000. August 31, 2022. 385,000. March-July, 2022. Around 470,000. January-February, 2022. Less than 400,000. Probably the most interesting thing in the latest report is that while the global estimated order backlog appears to be stable, that's not the case on the local level. According to Troy Teslike, we can see that the number of customers that await Tesla cars in the United States consistently increases, and at almost 69,000, is higher than in all the other markets combined. The first thought would be that the massive price reductions, a few times adjusted, combined with the $7,500 federal tax credit for Model 3 and Model Y, and lack of eligibility for some imported competitors, really attracted a high number of customers. If things remain like this, Tesla might again increase the prices here and there by the usual $500 or $1,000, but we would not expect anything drastic right now. On the contrary, in Europe and China, the queue of customers and expected delivery times shortened. We also saw reports that Tesla offered some interesting rebates for the Model 3 and Model Y cars in Europe, in transit. It means that price reduction might continue in 2023 to maintain production sales volume. Estimated order backlog. United States. 68,748 42 days, increased by 4 days in 2 weeks. Canada. 3,472 40 days, decreased by 10 days in 2 weeks. Europe. 14,211 19 days, decreased by 3 days in 2 weeks. China. 11,201 17 days, stable. Other. 8,628 56 days, decreased by 13 days in 2 weeks. Total. Roughly 106,260 30 days, stable. Source. Reposted and summarized from Mark Kane at Inside EVS. My take. It's nice to have that buffer of back orders to keep the machine rolling. Tesla Giga Shanghai further optimizes car deliveries in China by adding railroad. Tesla Giga Shanghai aims to optimize domestic vehicle deliveries while making them more environmentally friendly. The company began to transport cars by train there, which is a step forward in its development. Tesla in China is gaining momentum by expanding its ways of delivering cars. Previously, the company only transported them by trucks and ships, but now it has added another method. According to a Slachin Twitter post, Tesla has begun using the railroad as an additional option to deliver cars to remote regions of China. According to available information, the first train, with 120 Tesla cars, left Shanghai for Shenyang on March 13. The company began serving customers in Shenyang in 2018 and currently has 5 Tesla delivery centers there. In addition, the charging infrastructure is actively developing in the area, which contributes to the widespread introduction of the manufacturer's cars. Tesla began moving and transporting railways. On March 13, a train carrying 120 Tesla vehicles moved from Shanghai to Shenyang. This is the first time Tesla has adopted a direct train transportation method from its Shanghai plant to Shenyang since. TSLA Chan Slachin, March 16, 2023. The transportation of Tesla cars by train has a number of advantages. The company has the ability to quickly and cost-effectively deliver a lot of cars to the far regions of China. This in turn significantly reduces the company's carbon footprint by not requiring fuel to be burned by the trucks that deliver them. Tesla delivers hundreds of thousands of vehicles in China every year, and the number will continue to grow, so it is important to keep track of how they deliver. The company already uses the railroad to deliver its vehicles from its factories in the US and Germany. Source: reposted and summarized from Eva Fox at Tasmanian. My take: Tesla has to come up with some creative solutions to help with their logistics. Tesla's credit rating was upgraded to investment grade Moody's. Moody's Investors Service assigned a BA3 long-term issuer rating to Tesla and withdrew the BA1 corporate family rating, the BA1 PD probability of default rating, as well as the SGL1 speculative grade liquidity rating. The outlook is stable. The BA3 long-term Tesla rating reflects Moody's view that Tesla will maintain its position as one of the leading manufacturers of battery electric vehicles, as the company further solidifies its global footprint. Moody's anticipates that Tesla will deliver nearly 1.8 million vehicles in 2023, a 34% increase compared to the 1.3 million vehicles it delivered in 2022, and nearly double the deliveries in 2021. Considerable investments in new vehicle and battery cell production facilities enable a steep increase in vehicle deliveries. Tesla's product offering is expanding, with early production of Cybertruck slated for later this year. The development of a next-generation vehicle at a targeted 50% reduction in cost holds the prospect for a meaningful decrease in the reliance on the earnings contribution of Model 3 and Model Y. Tesla's growing scale, regional production facilities, and heightened focus on the efficiency of its manufacturing processes support an EBITDA margin that Moody's expects to be 15.8% in 2023. The margin compression relative to an industry-leading 18.9% EBITDA margin last year reflects a drop in Tesla's vehicle prices, amid a more competitive offering of battery electric vehicles by other automakers, changes in tax credits across geographies, and concerns about vehicle affordability. Moody's expects Tesla's financial policy to remain prudent. Financial leverage is well below 1 time after Tesla repaid about $10 billion of debt in the last 3 years. Other governance considerations are management's track record, balancing business accomplishments against notable key man risk, and close ties between members of the board and the CEO. The stable outlook reflects Moody's expectation that Tesla will continue to capitalize on robust growth in global demand for battery electric vehicles but in an increasingly competitive environment. Further, Moody's anticipates Tesla will maintain an industry-leading EBITDA margin in the next 12 months, albeit still largely reliant on only 2 models. Moodys anticipates that liquidity will remain very good, underpinned by a very sizable and growing balance of cash and investments, prospects for free cash flow of more than $7 billion, and limited debt maturities in the next 2 years. The rating could be upgraded if Tesla maintains a strong competitive global presence as other automakers offer an increasing number of battery electric models, and successfully broadens its product offering such that it reduces its reliance on the earnings contribution of Model 3 and Model Y. Tesla's ability to sustain an EBITDA margin in the high single digits, and a longer track record of a consistent, prudent financial policy are also important considerations for a higher rating. The rating could be downgraded if demand for Tesla models materially softens amid an expanding offering of battery electric vehicles by other automakers, or if Tesla is unable to sustain its EBITDA margin in the mid-single digits. A material shift in Tesla's financial policy that signals a greater tolerance for financial risk could also cause a ratings downgrade, including if debt-EBITDA is greater than 3 times, or if the amount of cash, investments, and committed revolver availability decreases considerably from current levels. Source: reposted and summarized from Eva Fox at Tasmanian. My take: it's about time. Moodys were really dragging their feet on this. Tesla rivals enter price war in China over customers. Tesla's rivals have entered into a price war with the company in China, in a battle for customers. Competitor sales in the largest market in the world continue to plummet, especially after the decline in prices for Tesla cars. Ford Motor Company, BMW Group, and Volkswagen AG have entered into a price war started by Tesla, according to the Wall Street Journal. They began offering big discounts and promotions on their electric vehicles after China phased out nationwide subsidies for the purchase of electric vehicles. At the same time, General Motors Company and Citroën have begun cutting prices even on their gasoline-powered cars. Overall car retail sales in China fell by almost a fifth in January and February from a year ago, with many consumers avoiding large purchases. Tesla has been one of the few that continue to record domestic sales growth. In early January, the manufacturer significantly reduced the price of its cars in China, which attracted a lot of attention from consumers. According to data collected, Ford has cut the cost of its Mustang Mach-E by about $6,000 through the end of April. Only 84 vehicles were sold in China last month, down from about 1,500 in December. The automaker only saw a spike in sales in December after cutting its original price by about 9%. In addition, according to industry data, manufacturers and dealers want to sell off about 500,000 older combustion engine vehicles. They are rushing to do so as the cars will soon no longer meet stricter emission standards. Volkswagen's joint venture with the Shanghai government said Thursday it is cutting prices on 20 petrol and electric models through the end of April, with discounts ranging from $2,200 to $7,300 per vehicle. The German automaker had previously slashed the price of its electric ID series by nearly $6,000. A Volkswagen spokesman said the company is offering temporary promotions due to general reluctance from car buyers, new emissions regulations, and discounts offered by competitors. Tesla's price cuts have spurred other automakers not only to cut prices on their vehicles but to intensify their search for ways to improve manufacturing processes to make them cheaper. Tesla is truly the motor of progress in the automotive industry around the world. Source: reposted and summarized from Eva Fox at Tasmanian. My take: the other car companies are fighting over Tesla's scraps. Who will be second?